Welcome to the world of Mark's Money Mind, coming to you this week from Longmont, Colorado. I'm your host, Mark Troutman. This educational personal finance show combines money lessons, timely topics, personal stories, and community wisdom to help listeners and viewers master their finances to enjoy a stress-free life of financial freedom. Well, wow, what a start to the month of April 2025. I'm recording this episode on Thursday, April 10th, actually in the middle of the day while the market is open, and it is going all over the place today. I'm just looking at it on my phone here real quick. It looks like, it's down about, 5 or 6% today after a huge rally yesterday. And so we're going to talk a little bit about market volatility. In just the first few weeks of the month, the stock market has dropped precipitously after the administration announced the implementation of the largest tariffs we've seen in the last 100 years. In fact, I believe the last time tariffs of this size were implemented was during the Great Depression. So that's a little concerning. And then just yesterday, the administration reversed course and said, hold on a second. We're going to take a brief pause here for 90 days. And that led to a massive rebound in the stock markets. So what should we make of all of this? First and foremost, it creates a significant amount of uncertainty, which the markets have had a lot of trouble digesting. Hence, this crazy volatility we're seeing in the stock market. And you may ask, are we in a bear market? Well, technically, and I don't know, we might be by the end of the day based on what's going on. So the low on Monday intraday actually was about 20% below its peak on, I believe it was February 19th, and that would be for the S&P 500. So on an intraday basis, you could argue that yes, we've reached bear market territory. Like I said, who knows if we will go there soon again in the next day or two, given everything going on. It's entirely possible. The NASDAQ, which tends to be more technology stock oriented, is in a bear market. That's down about 23%. And the Russell 2000 small cap is also in a bear market. So it probably will follow that the S&P will likely be in one as well. So what is a bear market? Well, a bear market is defined as a 20% drop from the previous highest point. And it's just a round number. It has no major significance, but that is what is determined to be a bear market, down 20% from a high point. Down 10% is referred to as a correction. So we certainly have had a correction. That means more than a 10% decline. A bear market would be 20%. Will we get there? Who knows? So what does this mean historically? Well, there was an interesting article that Morningstar published on April 1st, as a matter of fact. And no, it was no joke. It was a serious article. And it's entitled, What We've Learned from 150 Years of Stock Market Crashes. I think I referenced this article once before. What it talks about is the prior, they call them crashes, but we'll call them bear markets that we've had in the last 150 years. And they have counted 19 of them. I will actually pull up a chart on the YouTube channel so you can see it in graphical format. And this goes back all the way to 1870. And the article talks a lot about the severity of the different bear markets, both in their decline percentage and duration. Now, the most recent one that you may have experienced was what is termed the COVID-19 panic. The trough or the bottom of that bear market almost bear market, really, because it was a 19.6% drop from the peak in December of 2019 to the trough in March of 2020. It actually exceeded the prior peak in July of 2020. So what is that? April, May, June, July? It's 3 months. So very short. And that is what they are looking at, is when the peak was, when the trough was, and when the recovery was, which is effectively exceeding the prior high point. And that's what is considered a full cycle of the bear market, peak to trough, back to the peak. And they also did a pretty interesting job, and I'll let you read the article yourself. Again, I will put it in the show notes, of kind of the severity of the market decline. And the way they measured that was it was a combination of the percentage of the decline itself and also how long it took to get back to the previous peak. So the longer it takes and the deeper it is, the more severe it is. And they kind of came up with this thing called a pain index. And they had to reference that. So they made 100% pain be the worst one, which was the 1929 crash, where the peak of the market was August of 1929. The trough was May of 1932. So that's almost 3 years later. So a decline of 3 years. And that decline, peak to trough, was 79%. And it did not get back to its prior peak until November of 1936. So that's a little over 7 years. So that's considered the highest or the number one pain rank decline or bear market. So then they looked at all of the others. And like I said, I will intermittently put the graph up so you can kind of see these various bear markets. And if you're looking on YouTube, you will see those bear markets accentuated with a colored in red for the period of the bear market. And if you look at the COVID panic, I will also put up another graph that shows a more recent period, which isn't all the way from 1870, but it's from just before 2000. The lost decade is actually very interesting. Its peak, so the peak prior to the decline, was August of 2000. And the decline was 54%. From peak to trough, and that trough didn't occur until February of 2009, 9 years later. And if you look at the chart that is a little clearer, you can see that it actually rebounded quite a bit in 2008, almost back to the peak, but then dropped again during the financial crisis of 2008-9. So it never actually got back to the prior peak before having another major decline. But that decline, the bottom, was actually in February of 2009. And it didn't recover until May of 2013. So that's a 13-year period where the market had not gotten back to its previous peak. So that's why it's referred to as the lost decade, which includes both what is termed the dot-com bust and the global financial crisis, which was in 2008-9. And that actually has a pain ranking of number 3. So the third worst decline. So if you experience that, you have some experience with bear markets for sure. And it was a long, drawn-out period. In fact, it was kind of 2 market declines where it just never got back to the previous peak as the 2 declines occurred. The second worst one, according to this pain index, started, so the peak was June 1911. The trough was December 1920, so this is even before the Great Depression. And this was World War I and the influenza. And it did not recover until December of 1924, a full 13 years later after the prior peak. And the trough was in December of 1920, and that decline was 51%. So these are pretty major declines. We're nowhere near that now. Now, will we get there? Who knows? We just don't know. So kind of going back to where we are today, we have declined approximately 20%. If you look at other 20% kind of declines that kind of ended there, the most recent one really was in December 2021 was the peak. September 2022 was the trough. The recovery didn't occur until March of 2024, so about 3 years later. It was about a 28.5% decline, and that was a result of kind of Ukraine, the rise of inflation and shortages, and this was coming out of COVID, or really during COVID almost still, December 2021. I guess we were just kind of getting out of it. But that was, I would say, the most recent one, excluding that, the COVID-19 kind of blip. So what does this all mean for us? Well, I would suggest that you consider going back to episode 40, where we discussed the investment policy statement and sticking to it. The best thing to do in situations like this is really to look at your plan. What is your investment allocation? What is your target investment allocation according to your investment policy statement? What could I do today to potentially bring it back in line? So when you have a big market decline such as this, and we may have a bigger one coming forward, we just don't know, is maybe bring your target balances back in line based on your investment policy statement. I would not freak out and consider cashing out, because that's usually what happens is people have a lot of emotions during this time. It's reasonable to have these. Anyone that's been through this even multiple times has an increased level of uncertainty. Sometimes you're questioning yourself, but you really need to kind of fall back on what is the goal for these funds? What is the timeline? What does your investment policy statement say that you created during maybe calmer times? And sticking to it, really just saying, unless something significantly has changed from the standpoint of the reasons behind what you wrote in your investment policy statement, it would make sense to just stick to it and stay with your original plan. Now, like I said, some people, and there's been a lot of discussion about this on podcasts and in the press, and I've heard from various people that, they have different approaches. Some people will say, if the market is down 20%, for example, I will rebalance my portfolio. If it goes down another 10%, I will do it again. Another 10%, I'll do it again. Other people are saying, and rightfully so, saying, well, if the market is down 20% or more, maybe this is a good time to do a Roth conversion that I had originally planned on doing. Or even if I had not originally planned on doing a Roth conversion, basically what that means is moving money from your traditional IRA to your Roth IRA and paying the taxes on that conversion. If you are moving, let's say, shares of a holding that has gone down in value, you would be, let's say, that same 100 shares you had, hypothetically, is worth 20% less. You move those 100 shares over from your traditional IRA to your Roth IRA, you will be paying 20% less tax on that conversion. So that may be a good idea. For instance, if that was your original plan to do so, and it makes sense in your tax forecasting and situation. If and when the market recovers, potentially those shares would recover in that after-tax account, that Roth account, where you will not pay tax on those future gains. So it could be a very logical thing to do. Another thing I've heard some people doing is that maybe they are on a monthly contribution basis for funding their Roth 401k, for example, or Roth IRA, or even traditional IRA. And maybe they decide to accelerate some of those contributions. Now, the risk is that the market continues to go down. And you need to be ready for that because we don't know where the markets are going to go. They could go up drastically. They could go down drastically. We just don't know. So when you're making these moves and you're doing so at, let's say, a 20% market decline like we've had, maybe it makes sense to do it. But be aware that if the market goes down 30 or 40%, and I'm not saying it will, I'm just saying hypothetically, would you have kind of used all your dry powder and done all of your conversions when the market was down 20 and you wish you did some at 30 or 40? You could just dollar cost average, or you could increase your dollar cost averaging amount, for example. Another way to think about this is that in your account, let's say you own 100 shares of XYZ company. The price of those shares is priced every day in the market. Sometimes those share prices are high, like we saw, let's say, February 19th at the market high. And sometimes the price of those same shares is lower, like we've seen in the recent week. But you still own those same 100 shares. You are the same percentage owner of that fund or company if you own a company directly. Nothing has changed from your ownership perspective. Just the price that the market is willing to pay for those shares currently is what has changed. So I like to look at it from the standpoint that I own X number of shares of this fund and that fund. And even though the market prices are moving around, I'm still the holder of the same securities and amount of securities that I was in, let's say, February than I am today in April, as long as I haven't added to or subtracted from my positions. And it's only the opinions of the current market participants that is changing the valuation of those shares. But I still own the same number of shares. Just like when the market goes up a lot, people are like, ooh, look how much money I've made. Well, you only really technically make it if you were to sell those shares that you owned. And the same is true when people say, oh, the market is down, whatever, I've lost this much money. Again, only true if you have sold those shares. Temporarily, the valuation has changed between, say, February and April. And the same was true from, let's say, October to February when the market was going up. But unless you've changed your holdings in any way, your ownership stake has not changed. Just the market participants' willingness to pay whatever for those shares has changed. The more you are in the stock market, the more you're going to realize that these periods of time happen occasionally. Like over the last 150 years, there have been 19 bear markets, again defined as a drop of 20% from a prior peak. And declines of 10% typically occur on average around 2 or 3 times a year. We just haven't seen that recently. So this seems very unnerving. And most market declines are typically triggered by some kind of event. If we look back in history, it could be a war, it could be COVID, a virus that comes out of nowhere. It could be all kinds of different things. This time it was the stroke of a pen by an administration. Now, is that the entire cause for the market decline? No one knows specifically, but was it the kind of the straw on the camel's back? Potentially. And I'm not even sure if that's the right saying, straw on the camel's back. Anyway, you have to fact check me on that one. But anyway, the last straw. Maybe, maybe not. The good news is, to some degree, and we kind of saw this in the last day or so, is that with that same stroke of the pen, it could potentially be somewhat reversed. Now, would it be completely reversed? I'm not sure because of the magnitude of what was done by the administration. I think you lose a little bit of credibility with the world market participants. So will it just reverse itself, say, oh, never mind, that didn't really happen? No, people are going to remember that was implemented at some point and certainly could be in the future and may very well be again in the future because, again, this is just a 90-day pause. But market declines happen. They happen for various reasons, and we are currently in one once again. Now, last episode, and that would be episode, 43, I talked a little bit about Warren Buffett's approach to market volatility in discussing some comments he made in the 1997 shareholders letter, which I linked to in that episode. So you can go back and look at that link and read the entire context of his letter. But basically, he was talking about if the price of hamburgers declines and you're a lifetime purchaser of hamburgers, you would appreciate that, just like you may if you are a lifetime purchaser of common stocks. You should appreciate a market decline because you can buy the same shares at a lower price. Now, Charlie Munger, and if you're not familiar with Charlie Munger, he was the co-chairman of Berkshire Hathaway. He passed away, I think almost 2 years ago now, at just shy of his 100th birthday. And he's quite a character, extremely smart individual, and he kind of says it like it is. And so this morning I woke up and was reading some articles, and this article came across my feed from CNBC, and it was written by Ryan Ermey. Hopefully I've pronounced that correctly. And it was, like I said, published on Thursday, the 10th of April. And the title is Charlie Munger's Advice for Volatile Markets. And there are a number of quotes in here, which I would love to repeat because I've always loved Charlie's wisdom. Every time I went to one of the shareholder meetings, he was on the dais and always had very interesting things to say. And he doesn't talk as much as Warren Buffett, but when he does speak, I believe you should listen because he always has an interesting take on things and is very succinct and willing to say it like it is. And it was interesting because I actually posed a question to Charlie and Warren Buffett, and Charlie was the one that answered it, and it was quite profound. I won't go into the details of that, but the question was referring to the sustainable competitive advantage of Berkshire Hathaway once Warren Buffett and Charlie Munger are no longer there. And he was quite succinct and direct in his answer, and I thought it was very, very good. And he basically just said, it's the culture and the way we manage the business that will continue beyond the time that we are here because of the managers and people and process and approach to business that Berkshire has instilled at its core. Anyway, I won't get into that because that's not the subject of today's discussion. But some of the things that I think are interesting in this article, and I'm just going to pick out some of the quotes that the author attributed to Charlie Munger. And one of them was, the first one that I come across here is, he says, this is Charlie Munger, I think it's in the nature of long-term shareholding that the normal vicissitudes in the markets means that the long-term holder has the quoted value of his stocks go down by, say, 50%. And he attributes that to an interview that BBC did with Charlie Munger in 2009. And he continues, if you're not willing to keep your chin up during the occasional rout, you're not fit to be a common shareholder and you deserve the mediocre result you're going to get compared to the people who can be more philosophical about these market fluctuations. I love how he is just so direct, and he's willing to call out anyone who has a different opinion, I guess you would say. But he definitely states, or stated, now that he's passed away, his opinion quite clearly. But his point is you need to be prepared for declines that may be as much as 50%. And like I was saying earlier, there have been a number of those in the past. And a very brief market decline of 20% is kind of run of the mill. The big ones, like 50%, that go on and on and on for years, are what you need to be willing to stomach if you're going to be a long-term shareholder. That kind of comes with the territory. And in fact, Berkshire Hathaway itself, which both Charlie Munger and Warren Buffett had a majority of their net worth in, suffered 50% drawdowns or declines a multitude of times, while they, in Warren Buffett's case, are, and Charlie Munger's case, were shareholders. But the business didn't change. They still own the same shares in that business, but the market just came to the conclusion that at that moment, they were worth 50% less than they were previously. It doesn't mean that the business was significantly different. It's just what someone would be willing to pay on that given day. So I thought that was a kind of interesting quote. He was asked about having a sizable portion of his net worth in Berkshire Hathaway, and he basically said he didn't have any worries about it, and in those 50% declines, he had zero concerns. And he actually, in this article, it stated that this is the third time, so this must have been in the 2009 market decline. He said, this is the third time that Warren and I have seen our holdings in Berkshire Hathaway go down top tick to bottom tick, so peak to trough, by 50%. And they had no concerns about it and repeated the Buffett maxim of be fearful when others are greedy and be greedy when others are fearful. The article also talks about times of uncertainty and volatility in the market can be scary. So for anyone who is kind of scared or concerned now, this is not surprising. It would be a normal emotion to have. If you didn't have that, you probably weren't human to some degree. You're a robot or an AI bot. So yeah, market volatility is scary. And it is something that you should be aware that your emotions are going to potentially take hold, but you just need to be careful about them taking control of you. And in the article, Munger says, if you've been around long enough, you're likely going to live through a few of them. And that's very true. You're going to see these as a long-term investor. These are going to happen. Further, Munger is quoted, and this was when he was talking to students at the University of Michigan in 2011, which was, certainly during another volatile period. He said, I think you can count on more booms and busts over your remaining lifetime. How big and with what cyclicality, I can't tell you. I can tell you the best way of coping, which is just put your head down and behave credibly every day. And I think that's another thing that it was interesting. Going back to that question I had posed to Warren Buffett and Charlie Munger, I'm now recalling one of the quotes Charlie had. He said, one of the benefits or one of the attributes of Berkshire Hathaway is, he said, we remain rational when others are, I think he used the word insane or crazy or something to that effect. I wish I could recall the exact words, but he did say something to the effect of, we remain sane when others are not. And that is how Berkshire Hathaway has done well during these periods of market volatility. And again, I'm not suggesting you buy Berkshire Hathaway or anything like that. I'm just very familiar with the company. I've been a shareholder for a long period of time, and I pay attention to what they do especially during kind of interesting market periods. And during the big market decline during that lost decade, Berkshire Hathaway actually was a company that had a lot of cash on their balance sheet, just as they do today, and were able to make some really good deals for the company in the form of preferred shares. They did so, I recall, with, I think it was Harley Davidson, GE, if I recall, and a couple other large organizations where they were able to lend them money with some warrants and some very good terms because they remained rational during a period that others were irrational or certainly needed the support financially of another party. And what's interesting is Berkshire Hathaway right now has, I think, a little over $300 billion of short-term treasuries, which is effectively cash on their balance sheet, which is about a third of the assets. And it'll be interesting to see if they put that to work in any shape or form. Again, we're only down in the neighborhood of 20%, so this is kind of a run-of-the-mill correction. It'll be interesting to see if we're down 30, 40, 50%. And I would just say, keep your cool, stick to your investment policy statement, maybe rebalance on occasion, back to your target. And remember, you still own the same number of shares as long as you have not sold them. And historically, markets have always gone back past their prior peak at some point in time. There are times that it takes longer than others, so we don't know when the market would go back to its prior peak. But this is one of those times that I think it's very interesting to sit back and kind of analyze, how are you handling this period? Is this something that causes a lot of emotion? Are you able to kind of look at things philosophically or rationally? Or do your emotions get the better of you? And it really is it's only during these times that you really can evaluate how you act or feel during these periods. And so I think these times are actually instrumental as a long-term investor to understand your own kind of psychological makeup for being a long-term investor. And I will say that having been through these a number of times, it gets easier each time, because you can kind of look back and say, yeah, I remember the last time this happened, and boy, that was really scary, and I kept my cool and everything worked out. I know this is new for many of you, and this is probably the first time you've seen a major decline, except for maybe the COVID one, which was almost a blink of an eye. And who knows, maybe this will be a blink of an eye as well. We just don't know. And I am going to wrap it up here, and I'm just going to take a quick peek of my phone here and see that, there we go. The market was down a lot. Now it's up a lot. Not up. It's still down on the day. But I think it was down 5% or 6% at one point when I was starting this recording, and now it's down 3%. So that's a pretty big swing, 3 percentage points in, I think I've only been recording for 30 minutes or something to that effect. So yeah, very volatile times. And I would just try to tune out the noise. I'm not afraid of reading stuff because I know I can kind of check myself and I know how I think, and it doesn't bother me. But if it really causes a lot of anxiety, it's probably better to just tune out the noise, turn it off, go take a walk, ignore this stuff. Maybe just look at your statement once a quarter. Some people even just say, I don't even look at it except for once a year, because they know themselves and they're better off, not paying attention to what's going on. And I know that's very hard to do for most people, especially with social media being so present and everybody talking about this and all these things. But I think that sometimes it's best to just kind of tune out the noise. And there have been studies that have shown that the people that are the least active in their portfolios have some of the highest returns because they're not reactionary. So I would say, just in closing, if you want to pay attention to the markets, great. But don't let your emotions get the better of you. Try not to be reactionary. Stick to your investment policy statement. And we will just see how things go from here. And like I said, the market historically has always gone to a new high at some point, but it's not without its share of volatility. And that's what we are seeing today. So I am off on a big trip coming up. I will be going to Tahiti and Hawaii. So my plan is to record from the road. And again, sometimes that can be a little bit more sporadic depending on my internet capability. I will be on a cruise ship again, so sometimes it's good, sometimes not so good. So I'll do my best. It's kind of interesting that I get to go away and kind of ignore stuff for a little while, so that might be fun. Of course, you always have your phone and your information at your fingertips, so I won't be too far away from what's going on. But maybe we'll have another discussion about this at some point in the near future. Until then, let's just see what happens and just stick to your plan. That's what I would say. Stick to your plan and work your plan. Until next week, I will see you, or you will hear from me down the road. Thank you for listening to this week's show. Please click follow on your favorite podcast player or subscribe on YouTube to ensure you don't miss any future episodes. Also, please leave a rating and a review for the show. This helps improve the ranking and enables other like-minded people find the content in their podcast players. If you would like me to answer a question on the show, please send it to mark@marksmoneymind.com and put podcast question in the subject line. Let me know your first name, or let me know if you would like to remain anonymous, and also your state of residence if you choose. I would also appreciate it if you would recommend this show to friends and family that might benefit from this content. See you next time on the Mark's Money Mind Show. Until then, make some, save and invest, live on the rest. Now for the all-important disclaimer. This show is for education and entertainment purposes only and should not be considered investment, tax, or legal advice. Please consult the appropriate advisor or advisors before implementing anything you hear on this show or any other show for that matter. While I fully intend for everything on this show to be true and accurate at the time of each recording, occasionally errors may occur. So please do your own due diligence on anything discussed.